So I'm going to get started. Chapter 4 is all about using the cost function, changing it into a profit function or operating income function, and then using it to make predictions about the future and how we develop those functions or equations so that we can use it to predict the future. So I'm going to jump right in. Hopefully you've already watched the lecture videos. If you haven't watched the lecture videos, it is going to make it harder for you to understand. So I'm going to get started with exercise 4-13. It says contribution margin. We know what the definition of a contribution margin is. So let's just go over that. Contribution margin is equal to, and it doesn't matter whether it's per unit or in total, the formula is the same. So contribution margin is equal to the selling price minus the variable costs. Now the variable costs again can be can be total variable cost, total selling price equals total contribution margin, or it can be per unit. Then we're also looking at the contribution margin ratio. So the contribution margin ratio, when we're looking at this, how do we calculate the ratio, right? It is equal to the contribution margin divided by the selling price. So that's the ratio that tells us the percentage of the contribution margin based on the selling price. And this is very similar to our concept of gross margin. A gross margin is the sales revenue minus the cost of goods sold. That equals gross margin. We can calculate the gross margin percentage. We take the gross margin and divide it by the selling price. So we're really doing something similar to what we did in introductory financial accounting. Break-even point, let's do that. So when we look at the break-even point is equal to the fixed costs divided by the contribution margin. And I should correct this. This is total fixed costs, just to be clear, divided by the contribution margin per unit. So that's clear. We cannot use total contribution margin to calculate the break-even point. All right. And the break even in sales revenue, that's a little bit different. The break even in sales revenue is equal to the total fixed cost. I'm still spelling it wrong. I am just having total fixed cost divided by the contribution margin ratio. Right? So I'm just going to add that R there. So now we know how to calculate all of these things. We can calculate them right here. So it says next year, Jefferson Company expects to sell 350,000 units at $19 each. Variable costs are 60% of the selling price. Fixed costs are $874,000. Calculate the contribution margin per unit. Well, we already have the formula over here, so we can just apply. We know that the selling price is going to be $19 minus the per unit variable costs, because we're doing this per unit. That is equal to 60% of the selling price. So I'm going to take 0.6 and multiply it by the 19. And that should tell us what the contribution margin is. And the contribution margin here is $7.60. I'm just going to make that into dollars. So again, understanding this formula is really important, right? And again, we can calculate it per unit. We can also calculate it in total. But if we're going to calculate the break-even point, we need it per unit. So that's why I did it per unit. So next it says calculate the break-even point in units. This is break-even, and I should update this break-even in units. There we go. So now we know we're going to take the total fixed costs, which we know is $874,000. We're going to divide it by the contribution margin per unit, which is, of course, $7.60. And that means this is not dollars. This is units. So we don't want to put it in dollars. We want to put it in general. There we go. I'll put the little, there, get that. So this is 115,000 units. So I want to be clear, that is units. And again, what am I doing? I'm taking the fixed cost and dividing it by the contribution margin per unit. Then it says calculate the break-even in sales revenue. There's actually two ways we can calculate this. I could simply take this 150,000 units, and I can multiply it by the selling price per unit, which is 19. So that tells me it's 2,185,000. This is dollars. However, I've also got this formula right here. So, oh, I forgot to calculate the contribution margin ratio. So I'm going to take the $7.60 and I'm going to divide it by the selling price, which is 19. So this tells me it's 40%. Well, that makes sense because if variable costs are 60%, then the contribution margin is going to be 40%. And I'll show you that in a second. So now we can take the total fixed costs, which are 874,000, and we can divide it by the contribution margin ratio, and it should equal 2,185,000. And it does. 2,185,000, exactly the same. So you'll notice there's two ways to calculate it. A shortcut, if you've already calculated the units, you simply have to multiply it by the selling price. If you have the selling price. If you don't have the selling price, you're going to have to use this formula. So now, what else do they say? They say prepare an income statement for Jefferson at break even. Well, break even is 115,000, so we can create that income statement. We've got sales, and we know what sales are going to be. They're going to be the selling price, which is $19, multiplied by the number of units, and our number of units is 115,000 at break even. So we're going to take those two, multiply it, and we've got 2,185,000, which we knew we were going to get anyway, because we calculated it up here. Now we're going to say less variable costs. So remember, the variable costs are 60% of the selling price. So I'm going to take the selling price and I'm going to multiply it by 60%, $11.40. Still going to be 115. So over here, I'm going to multiply. There we go. So now sales minus variable costs are equal to the contribution margin. So keep in mind where I'm doing a contribution margin income statement here. Contribution margin is 874,000. We should know that that's what the contribution margin is going to be, because at break even, my operating income is going to be equal to 0. So I'm going to take the fixed costs right now, which is the 874,000. And when I deduct these two, it's going to be equal to 0. So my operating income is going to be equal to $0. I'm just going to put that as $0. I think it's still going to do a dash. It's going to do a dash automatically. So keep in mind, what does break even mean? It means that my total contribution margin is going to be equal to my fixed costs, which is going to result in an operating income of 0. I also want to remind you that this is a contribution margin income statement. It's calculating the contribution margin by deducting all of the variable costs. I'm going to move this over because I can't see the words variable costs. Sales minus variable costs is equal to the contribution margin. Now, remember, I was saying percentages. If we did this, variable costs as a percentage of total sales, we know already that this is going to be 60%, and we can see it's 60%. When we take the contribution margin and divide it by sales, this is going to be 40% because it's going to come up with the contribution margin ratio. And sure enough, it comes up with the contribution margin ratio. When I take sales and I divide it by sales, I get 100%, right? So if I change this into percent, this is 100%, and this is 60 and 40%. Just a second, I'm going to put it into percent. And then if I do this, I can show that 100 minus 60 is equal to 40. So that means I can use this. If they tell me that the contribution margin is 40%, I can calculate the variable cost as being 60% because I know this relationship between sales, variable costs, and the contribution margin. So it's really, really important you understand that. Notice if we take the per unit selling price and we take the variable costs, which we know is $11.40, and we subtract these two, this ratio will be the same. Sales revenue divided by sales revenue, 100%. Variable cost divided by the sales revenue, 60%. Contribution margin divided by the sales revenue, it's going to be 40%. So notice that this relationship, whether we do it in total or whether we do it per unit makes absolutely no difference whatsoever. The relationship is going to stay constant. Okay. Now it says conceptual connection. Break-even operations always result in a profit of how much? It's always going to result in a profit of 0 because we're breaking even. That means our total costs are even or equal to the total sales revenue.